How does a UK-based investment professional invest their own personal money? In today's video, I'm going to show you. I'm Jack. I'm an investment analyst for a wealth management company, and my full-time job is basically to invest our clients' money for long-term returns. And as part of this series, I update you periodically on my Hargreaves Lansdown ISA, stocks and shares ISA portfolio, see how it's done, break down exactly what funds I'm invested in, and talk a little bit about my thoughts on the market going forward. So in today's video, as usual, I'm going to take you through the portfolio as a whole, talk you through some different charts that show how it's performed in the recent period, and then I'm going to spend the last few minutes talking about the impact of the US dollar on my portfolio, not only over sort of the last month or so, where there's been a lot of volatility, but also the impact of the US dollar on any UK-based portfolio manager or portfolio over the last sort of decade or so. But before we get into the video, just want to remind everyone that this is not financial advice. This video is for entertainment purposes only. So with that said, let's come on to the portfolio dashboard. So here we are on the portfolio dashboard, and we're going to start with the two charts here, as we always do. And you can see that since that big sort of tariff announcement that caused a huge sell-off just over six weeks ago now, so it was the start of April that Trump announced Liberation Day, where he announced a ton of tariffs on different countries. We had a big sell-off in markets. You can see the value went from just under 10,300, it's on here, 10,300, all the way down to 9,300, which is a 10% drop in just a couple of weeks. It's quite significant given that there was no direct recession, but we've had a nice bounce back, and the market sort of been sideways for the last week or so. I've gone from 10,500 to 10,460. You can see the gain bar is still slightly below the contributions bar, sadly. When we come over to the TrustNet charts, you'll see that I started this series pretty much at the top of the market for the last 5 years. So pretty rough timing in terms of the series, but I think we can turn that around given enough time. Coming up to the top, and we can break it down by funds. So this portfolio doesn't hold any direct stocks, any direct bonds. It's all in mutual funds, no ETFs either at the moment. I think as we grow, we can look into different vehicles, investment trusts, that sort of thing. But for now, I think it makes sense to stick to mutual funds. And you can see that the only one that's in positive territory at the moment is Fidelity Special Situations, which is a UK-based fund. And I did a video on this a couple of weeks ago, and the UK market has been very unloved for a long time. And that ties into what I'm going to talk about later with the US dollar. And we're starting to see the UK sort of come back. Interest is slowly moving away from the US and into Europe, into UK, and Fidelity Special Situations has been a big beneficiary of that. Pharma has been disappointing. That's supposed to be quite a defensive fund, and it's down 12%. It's one of the weakest performers, which hasn't been ideal. American smaller companies, again, got whacked by Trump and whacked by the dollar, which again we're going to come on to. And the same for Henderson Tech Leaders. Polar Capital Global Insurance, if you've watched any of the other videos, you'll know is my favourite fund. It's pretty much, well, not financial advice, but it's pretty much recession proof. In my head, I expect this to do 10 to 15% a year for the next 3 to 5 years. So again, not financial advice, anything can happen, but it's the nature of the cash flow is very steady, either legally enforced or pretty much compulsory from shareholders. They invest the money that they receive into short-term bonds, which are yielding like 6-7% at the moment, where they used to yield 2 to 3. So everything is looking up for insurance. So despite the US dollar being weaker, despite everything going on in markets, being a US-based fund, or global-based fund, but the vast majority in the US, being down less than 1% is absolutely fantastic. So yeah, no buys or sells either to mention. I get paid in a couple of weeks, so we should have some money flowing in. Last time I actually put any money into this account was March, 2 months, which is quite annoying, but yeah, going forward, we should be able to pick that back up. So that was a very quick run through, but that's the dashboard covered off, and we'll come on to TrustNet. So here we are on TrustNet, and I'm going to start with the chart I always start with. It doesn't make me look too clever, but I think it's useful for context. So what we've got here is my portfolio, the one you've just seen, which is A, this red line, and the global sector, or the global benchmark, which is B. So every active fund, every passive fund goes into the IA global sector. And you can see that over the last 6 months, I have underperformed by just over 1%, which again, doesn't look great. But I think it makes sense given the calls I've made and how, well, pharma hasn't helped at all. That's supposed to be defensive, and that's been whacked by RFK coming into office. And, well, Trump recently spoke on his platform Truth and said that he was going to come after pharma companies and try and get them to lower prices. So that's been an awful time. The other two main detractors are the tech fund, which again has been hit hard by tariffs and recession uncertainty, and then you've got the Columbia Threadneedle American smaller companies, which US companies have been hit hard again by that recession uncertainty. And my portfolio, I think, has got, what was it, 15 or so % weighting to US smaller companies, where this global benchmark will have, well, they've got a smaller company sector, so it will have no allocation to smaller companies. So that's why that's happened. Again, not ideal, but it is what it is. I think over the longer term, that should come back. And I threw this chart up last time. It's not too fair because obviously this portfolio wasn't set up 3 years ago. But you can see that over the longer term, if my portfolio had been set up the way it is now, we'd have had a nice steady uptrend, beating the global sector. And that's what, honestly, I expect to happen over the longer term. We just have to give it time, given, again, my awful timing when it comes to this series, starting right here or on the global sector equivalent right here. And we've seen this huge sell-off and then this bounce back. The only other chart I wanted to show you on here was fund by fund. Not necessarily over 3 years, that's not too important. More so, I guess, over the last 6 months. There you can see the UK fund, special situations, steaming away, which is lovely to see. You can see Columbia Threadneedle there at the bottom, just down in the doldrums. The US small caps have been hit very hard by the uncertainty, as I just mentioned. We've also seen US government bond yields going up, which is really not ideal for smaller companies because a lot of their debt, i.e. what they owe to the bank, is based on floating rate. So not to get too technical, but when US rates go up, which they have been doing, the short of it is US smaller companies make less money. So that's not helped. You've got the uncertainty, you've got that rate story, you've got the US dollar story. It's been a terrible time. But long term, I think betting on capitalism in the most capitalistic economy in the world, which smaller companies are arguably best positioned to benefit from, is not a bad shout. Not financial advice. Anything else I'd bring to your attention? I guess Polar Capital Global Insurance. As I mentioned, it's a US denominated fund. I think 60 to 70% of the holdings will be US based. And for it to only be down, for it to only be down less than 1% over 6 months, in that context is very impressive. Given that, again, I have an internal benchmark of 10+% a year performance, for it to have very little downside capture is amazing. So yeah, that's the charts covered off. I know I went through them quite quickly, but given it's only been sort of 10 days since the last video, there's not much to say. I'm sure there'll be more eventful charts coming up with what Trump's up to and the volatility that he brings to markets. But the US dollar is something that I really wanted to touch on. I'm going to try and put up some charts. I don't have any to hand at the moment, but the US dollar has been a huge tailwind for UK investors over the last decade or so. It's down to a lot of things: trade policy, rate story, economic growth story, and also the appetite for US assets. So in some ways it's a self-fulfilling cycle whereby US assets outperform, i.e. the S&P 500, which I'm sure you'll be aware of, which brings international investors to want to invest in the S&P 500. To do that, they have to buy dollars because the S&P 500 is denominated in dollars. So you've got people buying dollars to buy an asset that's going up, which causes the asset to go up, which causes more dollars to flow in, which blah, 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 blah. You get a big story. You get USD going up, you get the index going up. And for a UK-based investor, again, that's sort of a double whammy. Again, you've got the asset going up and you've got the currency that the asset's denominated in going up. So as the UK investor, looking at things from a pounds perspective, your investment is doing absolutely incredible. The same works in reverse, and that's what we've started to see over the last month, 2 months, 3 months, where Trump has come in, said things that have undermined the trust, the confidence in the US economy and the willingness of basically the ease of trade, the ease of investment. If you're someone in and I see it myself. I, going forward, am far less likely to invest my marginal pound into the US smaller companies market, for example, because I don't want that US dollar exposure and the uncertainty that comes with Trump. Now, I have a long-term time horizon, so I can take that bet and sort of stomach it. But if I'm an institutional player, that's my clients are having a go at me every quarter because I've underperformed the benchmark, that's going to be more in the top of my mind, more at the front of my mind, that short-term performance. And I was at a number of conferences this week, and a continual story was, at the margin, the US dollar is likely to be weaker, the flow into US assets is likely to be less strong, and people are looking for international diversification. So going forward, as a UK investor, that's something you really have to think about. As I've said previously in this video, when you're holding US dollar denominated assets and they fall in value, and you haven't got the US dollar to cushion you, as you did in 2022, where there was a big sell-off in US markets, but the US dollar actually rose. So as a UK investor, you didn't see that big downturn. The opposite can happen, and it does happen. The S&P 500, the US dollar going up is all, I'm sure a lot of people on investment YouTube are under the age of 30. A lot of people that are watching this video are under the age of 30. So all you would have known since you've turned 18 is the US market outperforming and the US dollar going up. That does not always happen, and when it turns, it can be quite short and quite violent, which can be very painful for investors and cause you to sell out, or it can be prolonged, and then you've got a drag on performance for the next 10 years. And you've just got to think, do you want that in your portfolio? I mean, I look at this portfolio and I think, I don't want that much US dollar exposure. And that's a big component of why the drawdown's been 10 or so percent, or it was at the time, earlier in the month, or earlier in April. So it's something to think about. I'm going to try my best to find some good charts to pull up as I'm talking through this bit, and hopefully you'll have seen them as I've gone along. But what I'd like to leave you with, if I can, I guess, is just be careful about your international exposure. Be careful about your US dollar exposure, especially as a UK investor who perhaps has only known one market environment. So yeah, that's that. That's that. Have all the that's. Thank you for watching. If you enjoyed the video, please leave a like and subscribe, and I'll see you in the next one.